In October, major stock market indices hit fresh lows for the year, and the Federal Reserve is continuing to raise interest rates despite an extraordinary rise in inflation. Due to this, investors have revised their estimates of the value of a wide range of financial assets, including stocks, bonds, and the U.S. currency. Given this perplexing macroeconomic climate, investors might be tempted to liquidate their equities. But historically, trying to time the market has typically not been a smart move. Instead, investors can try to reduce the risk of their portfolio by purchasing shares in more reliable blue-chip companies that offer substantial dividends. These 10 dividend stocks to buy all offer yields above 3% while having significant upside potential once the current bear market lets up. Before starting, don't forget to like and subscribe to our channel for more future updates. So let's start. Number 10. Exxon Mobil Corp. Dividend hunters have historically found success in the energy sector. This has been particularly true in 2022, as oil and natural gas have been two of the few economic bright spots. Energy prices and sector profits have reached their highest level at least since 2014 as a result of supply shortages and geopolitical unpredictability. The company Exxon Mobil has benefited the most. When so many of its energy competitors cut back on expenditure on new projects in the late 2010s, it continued to invest in increased production. Exxon Mobil also retained ownership of its refining and chemical plant assets. Due to a rise in refining profit margins and shortages for different chemical products inside industrial supply chains, these firms currently making enormous profits. When all is considered, Exxon is still affordable, despite its significant rise over the previous year. Shares currently fetch around 9 times expected future earnings, and the stock yields 3.6%. Number 9. Verizon Communications Inc. One of the 3 major mobile phone companies in America is Verizon. Through its Fios division, the company also has major fiber-related operations. With its significant investments in 5G and spectrum to enhance the quality and speed of its network, Verizon was expected to experience fresh profitability. Instead, than expected, the returns on these investments have been slower. It makes sense why some investors are concerned when interest rates are rising and making Verizon's debt more expensive to service. These worries, though, are exaggerated. With consistent earnings, Verizon is trading at barely 7 times earnings. The company recently increased its dividend and hinted that a buyback would be forthcoming in the future. At the moment, shares yield roughly 7.3%. Number 8. Enbridge Inc. One of Canada's biggest energy firms is Enbridge. It is a pipeline operator with a specific focus on oil pipelines, and compared to many of its pipeline competitors, it consistently generates larger earnings and cash flows. This is mostly due to Enbridge's control of important pipelines that transport crude oil from Canada to U.S. refineries. Given the current inequalities in the refining supply chain and the legislative initiatives that have prevented the construction of new pipelines, this has been of utmost importance. The failure of initiatives like Keystone XL has increased the value of pipeline infrastructure that has already been constructed. When the energy bubble burst in the late 2010s, Enbridge kept its dividend when so many of its competitors had to cut theirs. With a current dividend yield of 7.1%, the company provides investors with a sizable income stream from vital infrastructure assets. Number 7. VF Corp. Vans, Timberland, and the North Face are just a few of the more than a dozen brands owned and operated by VF Corp, a diverse apparel firm. The company has increased its dividend for more than 25 years in a row and is a dividend aristocrat. That's a noteworthy feat, especially considering the garment industry's history of booms and busts. VF's success can be attributed in part to its industry-focused venture capital strategy. The corporation purchases struggling or small retail brands, grows them to a far stronger position, and then sells or spins them off. Investors' concerns about inflation and the economic slump have caused the value of VFC shares to drop by more than half over the past year. Number 6. Intel Corp. A terrible year has befallen Intel. Consumer demand has drastically decreased following the historic upswing in personal computer and gadgets sales in 2020 and 2021. According to tech research company Gartner, computer sales are currently down 19.5% for the most recent quarter compared to the same period in 2021. For PC chip manufacturers like Intel and Advanced Micro Devices Inc., this is a disastrous trend. Sales are down, but profit margins have also shrunk because it will be essential to discount items to clear out excess stock. Investors, though, have overreacted. Over the past year, shares of Intel have now decreased by more than 50%. For a blue-chip stock with a firm as durable as Intel's, that is an overstated move. Number 5. Unilever PLC. One of the biggest manufacturers of consumer goods is Unilever. It produces a wide range of goods for personal care, packaged foods, and home care. Due to consumers shifting preferences away from some of Unilever's more conservative brands, the company experienced difficulty increasing revenues in recent years. However, since the epidemic started in 2020, consumer spending patterns have changed, changing the situation. Unilever has now been better able to boost prices and improve the company's profit margins thanks to the inflationary climate. Activists have also called for reform at Unilever after seeing years of disappointing outcomes. Unilever CEO Alan Jope now expects to leave by the end of 2023, thus it seems like this strategy was successful. Number 4.3 Co. An industrial corporation called 3M produces a wide range of goods, including post-it notes, dental equipment, safety helmets, and transportation gear, among many other product categories. As a dividend king, the corporation has increased its payout for more than 50 years running. Given all the disturbances to the global economy during that time, that is a genuinely amazing performance. Shares of 3M are down more than 50% from their all-time highs, and investors are once again doubting the company. Inflation, a poor economy, and product liability lawsuits are among the current worries. These are legitimate worries, to be sure, but 3M has previously shown itself to be extremely resilient. Shares currently yield 5.5%, trade for less than 11 times projected earnings, and will profit from the present recovery in the American manufacturing sector. Number 3. Canadian Imperial Bank of Commerce. Banks in Canada have historically appeared to be more expensive than those in their southern neighbors. Given Canada's reputation for having an incredibly stable economy and regulatory system, this made sense. However, given the greater value and shaky foundation of Canada's stratospheric housing market, investors could have preferred to stay away. However, the situation is more appealing now. The housing market in Canada has stabilized, which should lower lenders' risk moving forward. Additionally, the valuation difference between Canadian and American banks has shrunk as a result of the sharp decline in Canadian bank pricing. One of the worst impacted stocks was CM, with shares down over 25% year to date as of October 14. As a result, shares now trade at less than 8 times projected earnings and have a 6% dividend yield. It's a good idea for investors who shunned Canadian banks because of their high valuations to give the industry another look right now. Number 2. Realty Income Corp. A triple net lease-focused real estate investment trust, or REIT, is Realty Income. These are leases where the tenant is responsible for paying the majority of operating costs, including utilities, as well as capital expenses to maintain and improve a property. Due to the special cost distribution between the landlord and tenant, triple net leases are one of the better real estate investment forms during an inflationary environment. Additionally, Realty Income has based its operations on dependable, superior tenants like FedEx Corporation and Walgreens Boots Alliance Inc. Realty Income's 5.1% annualized dividend is paid on a monthly timetable, providing income investors with a stream of payments that is more frequent. Since its peak in August, O stock has lost more than 20% of its value, bringing shares straight back into the buy range. Number 1. Northrim Bancorp Inc. The banking industry in Alaska is distinct. Given the state's remoteness from the rest of the nation, there are fewer than a dozen banks that compete there. One of the biggest locally owned banks in the state, Northrim enjoys significant scale and operational efficiency within its market. Northrim and other Alaskan banks often generate significantly larger net interest margins than banks in the contiguous U.S. because of the lower level of competition. Given that Alaska depends on oil revenue to pay royalties for the local economy, this structural advantage should become more pronounced in the future. With oil prices rising, Alaska should have greater consumer wealth, which improves Northrim's access to credit. The bank has already had successful operational outcomes. Less than 7 times prospective earnings are being paid out on the shares, and the bank increased its dividend by 22% in August. Currently, shares yield 4.5%. This is it for today's video. What do you think of our video? Tell us in the comment section below. Don't forget to like and subscribe to our channel for more future updates. Thanks for watching.